Hey folks, welcome to the Heritage Wealth Planning YouTube channel. Today we're going to talk about universal life insurance, and what you need to know about. We did a couple of videos on term life insurance and then on whole life insurance, and I made a point to tell you that there's a significant difference between universal life and whole life. So if you think about life insurance, you can separate it into two functions. One is permanent insurance and one is temporary. Permanent insurance is literally you can have it for as long as you want. It's up to you to maintain the policy, though. It's up to you. And you can divide the permanent section into a whole life and then universal life. And I'll get in that in just a second. And then the other section is term. And term, of course, is you have it for a temporary amount of time. It's like you're renting a home. After the term is up, the life insurance, the cost could go through the roof, and you're left without, or you don't need it. And so I'm a big fan of everybody having term anyway, without question, because term insurance is so doggone cheap, and you do not want to rely on your employer for your life insurance. I'm telling you, don't make the mistake I did. And if you don't understand what I'm talking about, go back to the video I put on term life insurance, and whoo, that could have been painful. All right, so then you have whole life, and just to reiterate what I said in the last video, whole life is flat level insurance. Basically, you're saying at the end of the day, I'm going to pay more on the front end so I can have a flat rate over the course of my whole life. And again, life insurance is a contractual obligation to the insurer, not to you. So it's a unilateral contract. You can do whatever you want. If you don't want to pay, you don't have to. You're not obligated whatsoever. You just don't have the life insurance. So that's what whole life is. Whole life just says we're going to pay a flat fee for as long as we want. And as long as we do that, the life insurance is the company's obligated to pay a death benefit when we die. Pretty simple. Now, universal life, on the other hand, that's a big difference. All right. Universal life is one I'm not the biggest fan of. I'm not going to lie to you. I tell you, I've seen a million universal life policies, and very, very few have I seen work the way they're supposed to. Now, the ones that have worked out have done actually quite well. I had a guy, he had millions of dollars of cash value in a universal life that he took out in the mid-'80s, early to mid-'80s. And that was when the interest rate's like 12% and whatnot. He funded that puppy heavily because he was a corporate CEO, or not CEO, an executive of some sort, making big bucks. And he overfunded that in the first couple of years, and that sucker was doing great. And he was getting 5.5% guaranteed. And it just is insane how well that did. But for every one of him, I've had 100 people who, if you look at the InForce Illustration. So remember, if you have a universal life insurance, you need to get what's called an InForce Illustration. Not your statement. Your statement doesn't tell you squat. Your statement just says how much cash you have in there and how much cash you had the previous year, what your premiums are, and what your death benefit is. There's nothing inherently wrong with that, but it doesn't tell you the strength of the policy going forward. And that's what the InForce Illustration says, and no one gets these things. So an InForce Illustration says very explicitly, Mr. Insurance Company, tell me, based on the guarantees that you are provided to me when we sign this obligation, contractual obligation, what this insurance policy will look like in 5, 10, 15, 20, 25 years. Tell me what a midpoint is with a certain level of interest and a certain level of fees and costs associated with it. And then tell me what, I hate to say a best case scenario, but a good case scenario. So you got the guarantee, you got the midpoint, and you got a good case scenario. And there's 3 different mechanisms to look at these things. And they're going to show you your InForce Illustration, Mr. Josh, in 15 years under the guarantee is going to blow up, the lapse, because you're not receiving enough interest to support the increasing cost of the life insurance. So if you have $2,000 as your cost of insurance, and right now it's only costing you $1,500, or it was $2,000 as your interest, that you're receiving on the cash value that you have in there. So it's almost like a bank. You have a CD at the bank. You got $25,000. It's paying you 2% a year in interest. That's $500 a year in interest, which is great. So you're giving you, in this case, $2,000 in interest, but it's only costing you $1,500 because you're younger and in good shape. So that's great. So you're netting $500 after the cost of insurance, a COI. However, as you get older, that cost of insurance creeps up. So now it costs $1,700 a year. $1,900 a year, and then $2,100 a year. What if I'm still only getting $2,000 a year in interest? It costs me $2,100 for the cost of insurance, but I'm only getting $2,000 a year in interest. That means I'm losing $100 a year. That $100 is going to come from someplace. It's going to come from the cash value that's already accumulated. Going back to the CD example, I have $25,000 of cash in there. So they're going to take $100 from that because I didn't have enough interest to cover the cost. So now you wake up, you only have $24,900 in cash in there. The next year, my interest, the cost of insurance is $2,300, but I'm making less on the cash value because I have less cash value. So instead of making $2,000, I'm only making $1,950. So now there's a $350 corridor that's got to come from the cash value. And so now it's a vicious cycle. And so now the cash value is down to $24,500, which means my level of interest I'm receiving on the cash is slowly being depleted. At the same time, my cost of insurance are going up at the most inopportune time because now I'm 65, 66. And it's not a gradual increase either, my friends. When you see the cost of insurance tables, it kind of goes up, that goes like that. It jumps like Superman flying through the air. It's crazy. And then you get to 70 years old. Bad. So what happens on these older policies is not only does the cost of insurance increase as you age, and they knew that, the insurance companies didn't lie about that. But the problem is that not only was your cash value not keeping up, but you weren't making enough interest because the interest rates have dropped like a brick in water. So when they're issuing the policy, they said, we think you can make 6% interest or 7% interest or 5% interest. Lo and behold, the 10-year Treasury bond is paying 2.85. So you're getting half or a third of the interest that you're getting. And that policy was positioned based on the ability of you to get enough interest in there to pay the premiums. It just hasn't worked out. It's so far away. What the 10-year Treasury doing again now? I think is at 2. Let's see. Everything revolves around the 10-year Treasury. If you watch my videos enough, you'll see I'm always looking at 10-year Treasury. 2.96, as you can see that in red right there. That's the yield on the 10-year Treasury right now. Everything revolves around that one number. Forget that Facebook stock. Forget the S&P 500. Everything revolves around the 10-year Treasury because the insurance companies and the pensions and whatnot have tons and tons and tons of bonds to pay their pensions, to pay the insurers. And if those 10-year Treasuries yields don't go up anytime soon, they're going to be in a world of hurt, which is why a lot of these pensions and stuff are wondering how they're going to make ends meet because they don't have it. Life insurance is the same thing. They're like, ooh, that's why long-term care carriers have gone out because they just can't afford the premium. They've undercut the premiums. They can't afford with these low interest rates to keep assuming the risk. So they're stopping issuing long-term care because of the low interest rates. I'd like low interest rates because this house behind me, as you can see, I got debt on this puppy. And the low interest rate is good for me, but it's bad if I'm buying a permanent life insurance policy that was contingent on a higher level of interest. I know that's confusing, but if you have a universal life, not a whole life so much. Whole life is fine if you want to get an InForce Illustration. But if you have a UL, a universal life, you have to get an InForce Illustration every 3 years. Because again, that will show you your cash value, the cost of insurance, which is growing each and every year, and your interest that you're making on that cash value, and whether or not that interest plus your premium will be enough to cover that cost, the increasing cost of insurance. I'm telling you, my friends, a lot of times it's not. And what happens when the cost of insurance goes up, and all of a sudden your cash value is gone? Then your premiums won't cover the death benefit anymore, and that policy will lapse. And all the cash you had in there, all the cash you had is gone, and then your death benefit will be gone. And the thing that ticks me off is that you'll get some letter 6 months out from your life insurance company says, "Oh, Josh, remember that policy you bought back in 1992? Yeah. That's going to lapse if you don't pay $50,000 in cash into it, or increase your premiums to $3,000 a month when initially it's $400 a month." You're like, huh? I thought that puppy was guaranteed. No, no, no. We never says guaranteed. No, this isn't whole life, Josh. This is universal life. We said there's a risk that if it wasn't properly funded, the policy could go kaput. Okay. Well, I'd like to talk to the agent who sold it to me. Oh, no, no. That agent's long gone. All right. So if this policy lapses, did he still keep his commission? Yeah, yeah. And you did too, Mr. Insurance Company? Yeah, well, we've been sending you a note every year about your statement on the policy. Yeah, but the statement never said this policy was doomed. The statement just said you have $80,000 of cash value and you're paying $5,000 a year on a $500,000 death benefit. So 5 years go by, $30,000 in cash value, paying $5,000 a year. I'm not a life insurance professional, so that didn't occur to me to think I lost $50,000 in cash and my premiums are still the same, that this policy has a potential to lapse, especially when I bought that sucker. The insurance agent who sold it to me said if I made these premiums under this assumption that we're using, is a pretty fair assumption back in 1992 with the interest rates the way they were, that this policy will stay there for the rest of my life. No, I'm the one holding the wet bag. Insurance company's not, and agent's long gone. It's not right. But I hate to say it, it's on you, Mr. Josh, you, the client. If you don't get an InForce Illustration, the insurance company doesn't just send it to you. They don't care. Yes, they do care. I know the insurance companies are as pure as winter and snow. Trust me. The insurance company, the last thing that they're going to do is have somebody on the phone calling you up and saying, hey, you had better get InForce Illustration because the policy that we sold you, on which we've been making money off you, on which we got commission, that policy is about to lapse. It's not going to happen. And I hate to sound like I'm, what's the word of skeptical, right? A cynic, that's the word. I've seen it happen with some of the better insurance companies out there. They're going to put it on you. They're going to say, this policy is about to lapse. You need to do something. And by then, you're 72 years old. You don't got a pot to pee in. You don't have $50,000 to throw at the stupid life insurance policy. You don't have an extra $3,000 a month to pay for the premium. That doesn't happen in whole life. That does not happen in whole life, because whole life, you will know for a fact, is 100% contractual guaranteed. If you do this, this is the result. And nothing else will go in between that. You do this, this is the result. So whole life is not very sexy because you don't get a lot of interest necessarily because the insurance companies take on the risk. But because they're taking on the risk, they doggone make sure that they don't assume a lot of risk that they can't pay. So they give you a lower interest rate on the front end to guarantee that they're going to make enough money in their capital reserve to pay off the debt, i.e. the death benefit when you die. With universal life, though, it's a completely different thing. And the worst thing is got these things called variable universal life, VUL. And those are based on the equity, well, not even the equity market, the investment market, a portion of which is bonds and some of which is stocks. So if you have a market that returns, let's just say the last decade, 2000, 2009, even if you had a well-balanced, diversified portfolio like we talked about in yesterday's episode, that only gave you 3% a year. That's before what's called M&E, mortality expense, and that's before cost of living, or not cost of living, cost of insurance, and the investment fees. So life insurance can cost you well over 3% a year because of all the different fees they put on there. Just like an annuity can cost you 3% a year. So if you get 3% a year from 2000 to 2009, and on top of that, you're losing all that for fees, which you certainly are, you get a big fat goose egg for your net return, and then the costs of insurance are going up and up and up and up and up. And now 10 years, 15, 20 years hence, what was costing you $300 a month for cost of insurance is now costing you $3,000 or whatever. Yeah. Has universal life worked? Has variable universal life worked? It's all, yes, it can. Well, I'm not debating that. However, in my experience, it works a whole lot less than it shows. Then it fails a whole lot more than it works. Don't let that failure be you. Get your InForce Illustration. If you don't know how to analyze it, contact somebody who can look at it with you. Pay some guy a fee, $250 or whatever, that's what it costs, to get an independent third-party look at it. Do not get the insurance company to look at it with you because they're going to say, you know, yeah, we have a better product now. We have a better product. Maybe you should switch that out to an annuity. No, I mean, that might be an option. But remember, going from life to annuity, when you go to Louisiana, is not a tax-free event. You're going from tax-free life insurance to tax-deferred in an annuity. You can do it. The IRS is very comfortable with you doing that because you're taking what was going to be tax-free lump sum at your death, and you're making a taxable distribution at your death. You can go to Louisiana, but you can't go to Alabama. You can't go to annuity to life because it's tax deferred to tax free. Can't do that, but you can go to Louisiana. So remember, LA, yep. AL, no. Louisiana, yep. Alabama, no. And what an insurance company might say is, hey, we got, yes, you got $35,000 in there, Mrs. Smith. Why don't we just put that into an annuity and lock that in so you don't lose it? I mean, that might work. That might work if that's all your options. But you don't want the insurance company who sold it to you to give you another option because they're the ones who steered you wrong to begin with. All right, that's my diatribe for the day. Universal life insurance. Not a fan. That doesn't mean don't have it. I have some universal life. Actually, do I have it for my kids? I think I even can't. No, I have whole life. I like whole life a lot better because you get a pretty significant understanding of what it's going to cost and what it'll look like. Universal life is way too contingent on things like the markets, things like the insurance companies, things like their ability to pay their expenses. And if they can't pay, they're going to, who knows? There's way too much stuff in there. And I tell you, I've been experienced now long enough. I'm a cynic that they're going to do anything that's beneficial to you as opposed to beneficial to them. All right. So let's wrap this up. You got term, temporary insurance, like renting a house. You got permanent. You got two types of permanent. You got universal and you got whole life. Whole life is guaranteed for your whole life. You make the payment, they guarantee it. The payments won't be cheap, but they will be level and they'll never change. It's a whole lot more expensive than term, let me tell you. Universal life, you can underfund it on the front end, which a lot of people do just to get you the contract. And that way your payments will be lower on the front end. But man, if that sucker doesn't get some serious cash value in there in the first 10 years of the contract, it's going to be hard to make that puppy work. In fact, I would be willing to predict you're not going to survive that policy, or that policy won't survive you, I should say. You will survive the policy. And if you survive the policy, that means the policy did not work because the policy is there to give you a death benefit at your death. If you survive it, that either means you took the cash value out or you canceled it or the policy lapsed. Either of those three things are not good financial planning. Rules, why'd you do to begin with? All right. So if you like what you see here, my friends, don't forget to subscribe. I think it's on that side when I'm doing it live. Subscribe down below. Comments are always welcome. Absolutely. If you do subscribe, hit the bell to be notified for future content. Go to the blog at heritagewealthplanning.com. heritagewealthplanning.com. And I tell you, give me some comments. I'd love to hear your feedback on your life insurance exploits because I tell you, I think if you can say stuff for other viewers to see what the real world is on universal life insurance or whole life insurance or life insurance as a whole, I think it'd be very helpful. See you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.